It's time for Business Blueprints, from pixels to patterns. This is where we break down the journey of tomorrow's titans.
Welcome to the deep dive. We've got a fascinating collection of source material today, really pulled directly from conversations you've shared with us. The topic.
Yeah.
It's this incredibly diverse landscape of, well, building businesses. We're going from the everyday grind of e-commerce all the way up to these massive, almost unbelievable forces shaping global finance. And the surprising role something like Bitcoin is playing in all of it.
That's right. We've been digging into recent discussions from the My First Million podcast. And that gives us this really sharp kind of ground level perspective, tactical e-commerce strategies, how people are spotting trends, acting on them right now. And then, yeah, we make this huge leap. We're diving into material from Preston Pish's show, specifically some deep dives into Bitcoin fundamentals, featuring guests like Alex Gladstein, Andy Edstrom, and Jack Mahler. So big names, big ideas.
It's quite the range, isn't it? I mean, going from mastering Facebook ads for like a wallet to trying to understand the potential breakdown of the entire global monetary system. Our mission here in this deep dive is to take all these pieces, the practical stuff, the philosophical, the financial, even the sometimes contradictory viewpoints, and really try to extract the most valuable nuggets for you.
Yeah, what are the core strategies actually working today? What are the surprising dynamics really at play here?
Exactly. What does this stack of sources, this grab bag of insights, reveal about building value, about navigating the world of finance in, well, 2024 and beyond? Let's unpack this together. Okay, let's start right there on the ground floor. My first million source material. This stuff really paints a clear picture of the current e-commerce landscape, what it actually takes to build a successful online business today when it feels like everything's absolutely saturated.
It really does. And a recurring theme, a core insight from those discussions is what you might call the simple hustle. It's easy to think you need some like revolutionary tech or a completely novel product idea, but often success comes from focusing on something incredibly practical, maybe even mundane, right?
Yeah.
And then just executing the core business functions, especially marketing, with an almost obsessive level of detail. Real excellence in execution.
And the prime example they keep bringing up from the sources is Ridge Wallet. I mean,
Right.
on the surface, it's a wallet, as one host put it, selling the practical thing ever.
Yeah, exactly.
But its success, it wasn't really about the inherent innovation of the product itself, was it?
Not really, no.
Yeah.
The sources attribute it squarely to the execution, particularly in customer acquisition,
Yeah.
getting those first customers.
Right. The source material points out that Ridge Wallet got highlighted because they managed to avoid what they called stupid competition. At the time they were scaling up, they were like uniquely effective at running Facebook ads, specifically targeting people who needed, well, a new wallet.
And this is where that simple hustle idea meets the hard reality of e-commerce today.
Because making performance marketing, things like Facebook ads, work profitably for a product like a wallet, that's incredibly difficult, right?
Oh, immensely so, yeah.
Yeah.
This gets right to a key concept in e-commerce. Customer lifetime value, LTV. For a product you buy once, maybe twice in your entire life, like a wallet, the LTV is inherently low, super low.
Right. You make most, maybe all of your profit on that very first sale.
That's it.
So it's not like a subscription box or, coffee beans where a customer might spend hundreds, even thousands over time. With Wallet, you basically get one shot.
Exactly, one shot. And that means you must acquire that customer profitably on day one, on that initial transaction. The cost to acquire that customer, through your ads, whatever, it has to be significantly less than the immediate profit you make from selling them that wallet.
And the source notes that plenty of competitors trying similar things, selling practical stuff online, they failed precisely because they couldn't nail this fundamental equation.
Yeah, they couldn't figure out how to acquire customers day after day, week after week profitably. It's a tough game.
So the real nugget of wisdom here isn't just sell something practical. It seems like it's more. Even the simplest, most obvious business idea requires mastering the single hardest part of modern online commerce, which is repeatable, profitable customer acquisition, especially when your LTV, your customer lifetime value, is low.
Right.
That's the actual blueprint behind something like Ridge Wallet's success, isn't it?
It totally flips the script. The difficulty isn't the idea, it's the grueling tactical grind of making the economics work, especially in those really competitive advertising environments like Facebook.
Okay, so that's one blueprint. Simple product, masterful execution, really nailing that direct response marketing. Now let's shift gears a bit, still within e-commerce from the My First Million sources, but to something that feels almost opposite. Spotting and writing fast trends. This seems presented as a way to maybe bypass some of that saturation we just talked about.
It is, yeah. The sources definitely suggest that capitalizing on fast emerging trends is critical if you want rapid growth in e-commerce today. It's about finding those waves, before everyone else piles in and just riding them hard. And the standout example discussed here is the wobbles.
Ah, the wobbles. That's the crocheting product, right? Where you make those little characters. It involves licensing, has an educational angle too,
Yeah,
teaching people how to crochet.
exactly. And the growth trajectory mentioned is, well, it's truly remarkable. The source notes that when the My First Million hosts first connected with the founders, the business might have been doing, say, $10 million a year. Maybe. Then, in just 2 years, they scaled to potentially $150 million in revenue.
Wow, $150 million in 2 years. That's staggering growth.
And importantly, the source highlights this. They did it without raising any outside capital, zero external funding.
Bootstrapped hypergrowth. That's incredible.
It really is, powered by just hitting a trend perfectly.
And the positioning sounds brilliant too, leveraging that whole societal trend against excessive screen time, especially for kids, right?
Absolutely. It offers something tangible, creative, and alternative.
It taps directly into what a lot of parents and educators too are actively looking for right now.
Definitely. And yet, the sources pointed out what they saw as maybe a significant missed opportunity.
Oh, what was that?
The founders apparently hadn't launched subscription boxes.
Really? A subscription box for a crocheting product like that seems like, well, a perfect fit. New characters each month, new patterns, maybe a community thing.
Exactly. The sources felt it was just such a natural extension. Could add significant recurring revenue, boost that LTV we were talking about. The fact they achieved that massive $150 million growth without implementing this seemingly obvious strategy, it made the existing execution look even more impressive.
Yeah, I could see that.
Led them to describe Wubbles as maybe the single best brand and execution they've seen recently, with clear potential for a, billion-dollar exit. Huge potential.
Okay, so if writing fast trends is a key blueprint for that kind of rapid growth, how does one even find these trends? The advice given in the sources for new founders seemed interesting, strategic.
Yeah, the suggestion was a bit counterintuitive, actually. They said, start by learning how to make money by offering online services first. Don't jump straight into trying to launch a physical product.
Why services first?
The idea is, once you understand how to generate revenue online, how to serve customers, deal with support, the basics, then you're much better equipped to actually identify and capitalize on a fast emerging product trend when you see one.
That makes a lot of sense. Build the fundamental business skills first, then apply them to a trend. So what specific trends were highlighted in the sources as having potential, say, over the next 2-3 years?
Well, no screen time came up repeatedly as a major one. Still has legs. This points towards more physical, tactile toys, activities, maybe even a resurgence of things like Lego, or kind of humorously bringing back fidget spinners, but positioning them differently, maybe as focus tools for adults or students.
Okay, no screen time. What else?
Creatine was mentioned specifically. The sources pointed to it as a supplement trend with significant current momentum and still room to grow.
Interesting. Any others?
Beyond those, yeah, there were a few other potential fast trends discussed, things related to microplastics awareness. That could drive demand for products like glass containers, anything genuinely plastic-free.
Yeah.
Colostrum also came up. And raw honey, potential comeback trends, or niches seeing renewed interest.
So how do you actually find this? Where should people be looking?
The key takeaway for finding them was really practical. First, look in your own life. Seriously, what are you seeing? What are people around you, your friends, family, colleagues? What are they talking about or doing that feels new or different? What are they passionate about? And then, explore platforms like Etsy and Reddit. Those niche communities and specific interests often bubble up there early, before they hit the mainstream consciousness.
That's solid, actionable advice. Look around you. Check the niche platforms. Okay, now let's talk about how the marketing side of writing these trends is evolving. Specifically, this thing called the TikTok blueprint in the source material.
Right. This was highlighted using the example of another company, Brez, saw rapid growth, hit something like $4.6 million in revenue by month 21. Pretty fast. But what was particularly interesting was the breakdown of their marketing strategy, their spend.
Yeah, the spend was weird, right? The source showed they were spending heavily on the traditional platforms like $1 million on Facebook, 400K on Google Ads, standard stuff. But their reported TikTok ad spend was zero. Zip.
Exactly. Zero reported TikTok ad spend, yet they're presented as successfully using the TikTok blueprint. So this is where the model differs significantly. The TikTok blueprint, as described, relies way more heavily on organic content and affiliate marketing rather than direct paid advertising in the traditional sense.
So less about pouring money directly into TikTok ads and more about
Right.
content volume.
Pretty much. Putting out thousands of pieces of content a month, that was the quote. It's described as a kind of spray and pray approach to content creation. You just create tons of short videos hoping that some of them pop off, go viral or gain significant organic reach. And that organic reach drives traffic and sales, either through affiliate links embedded somewhere or maybe TikTok's own shopping features.
Which allows for potentially very, very cheap CPMs, cost per thousand impressions, if your content actually resonates and the algorithm picks it up.
Precisely. It's a fundamentally different approach from the classic Facebook-Google model, where you generally have a much clearer, more direct line of sight. Dollar in, attributed revenue out.
Yeah, the TikTok model sounds more chaotic, maybe less predictable day to day, but potentially much higher leverage if you actually hit a winner if something goes viral.
That's exactly the trade-off. And the analysis from the sources is basically that rapid e-commerce success today, it increasingly depends less on just having a good product alone. It's more about choosing the right product and trend combo right from the start, having a compelling angle, and then mastering these newer marketing tactics centered around high-volume, algorithm-driven organic content, not just relying solely on direct paid ads anymore. It's a significant shift in the e-commerce blueprint.
It's really incredible to see these ground-level business tactics scaling companies into the multi-million, sometimes hundreds of millions so quickly. From mastering customer acquisition on a simple wallet to catching lightning in a bottle with a crochet kit and the TikTok algorithm. Amazing stuff. Hey, if you're finding this valuable, do us a favor and drop a like, maybe share it with someone who'd find it interesting too. Okay, so we've looked at these tactical blueprints for building businesses right there at the e-commerce level. Super practical stuff. Now let's make a massive jump, a huge leap in scale and perspective. The source material from Preston Peach and his guests. This takes us way up into the realm of global macroeconomics and the surprising, maybe even controversial, role of Bitcoin within that whole system.
Yeah, this section frames the current global financial environment very differently. Not as like a stable system with maybe some temporary issues, but as the active unwinding of the entire monetary order that was established after World War II. The core idea presented is that the foundation of this system, the whole thing built around the US dollar being the world reserve currency, it's showing fundamental cracks. It's starting to break down.
Okay, tell us more about that post-WWII system, as the sources describe it. What was the original setup supposed to be?
Well, after the war, the U.S. was in this really unique position, right? It held most of the world's gold, had by far the strongest economy, the strongest manufacturing base. Untouched, really. So the idea basically was that the U.S. would export its economic strength and stability via the dollar. The dollar would be the bedrock. Other countries, recovering ones in Europe like Germany, developing economies like Russia or China, or rapidly industrializing ones like Japan, they would specialize. Russia providing resources, China manufacturing goods, Germany building cars, Japan driving growth. And they'd export those real goods and services back to the U.S. consumer.
So the U.S. effectively became the world's consumer of last resort, importing all the real stuff and exporting dollars.
Precisely. And as the source points out, this became especially true after the U.S. went off the gold standard in '71. The system really evolved into effectively the U.S. printing fiat currency, paper dollars, in exchange for real, tangible goods from around the world. Energy, food, raw materials, electronics, cars, you name it. The source describes this relationship, this structure, as fundamentally not very sustainable over the long haul.
Because, well, eventually other countries might start questioning the value of holding endless amounts of paper dollars they get for their finite real resources.
Exactly. That's part of it. And a key structural consequence of this whole system is that the U.S. has consistently, year after year, run a trade deficit. In business terms, the source kind of frames this as the U.S. running unprofitably, continuously importing more real value than it exports, and offsetting that difference by exporting paper currency, basically IOUs.
Okay. And on the flip side, countries exporting huge amounts to the U.S., like China, for example, they run massive trade surpluses. the source calls that running extremely profitably.
Right. They're accumulating huge reserves of dollars from selling real goods.
But these surplus countries, they couldn't just take those mountains of dollars and, invest them all back into their own local economies, could they?
Well, no. If they did that on a massive scale, it would strengthen their own local currency dramatically. Which sounds good, but it makes their labor and their exports much more expensive on the global market. Less competitive, hurts their export machine.
Ah, okay. So all that surplus capital, those trillions of dollars earned from exporting real stuff, it needed somewhere else to go. Where did it go historically?
Historically, the main place was U.S. Treasuries. Lending those dollars right back to the U.S. government, it was seen as the safest, deepest, most liquid market in the world.
But the source suggests a pivot happened, a shift, particularly after the 2008 financial crisis.
Yes. The argument presented in the source is that after the '08 crisis, the Federal Reserve's actions and maybe priorities shifted. They focused heavily on stabilizing Wall Street, maybe appeasing domestic voters, leading to policies like QE, zero interest rates, which were arguably less favorable to global partners holding vast dollar reserves and treasuries paying very little interest.
Okay, so what did those surplus countries do then?
This incentivized them, countries like China in particular, to increasingly pivot their investments away from just low-yielding treasuries and into other U.S. financial assets, things like the NASDAQ Q stock market, especially the big tech stocks, the Mag 7, and also U.S. real estate, pouring capital into those assets instead.
And what was the described outcome of this whole dynamic, this structural deficit system plus the capital flow shift?
The sources strongly link it directly to the massive wealth gap we see in the U.S. today. It's presented as a major contributing factor. Those who already owned financial assets, stocks, real estate, they benefited immensely from these huge global capital flows, chasing yield and safety, bidding up prices.
Right, asset price inflation.
Exactly. Meanwhile, the middle and lower classes in the U.S., they faced rising costs for essential goods, cars, housing, food, which often rely heavily on imported components or global commodity markets influenced by these flows. And at the same time, they often saw manufacturing jobs moving overseas as part of this global trade system that prioritized cheap imports funded by dollar exports.
So it's presented as a system that maybe it was initially designed to help post-war recovery, but it morphed into an engine of, unsustainability and growing domestic inequality.
That's the core argument, yeah. And what's particularly compelling, I think, is how this current breakdown is situated within a larger historical perspective. The sources argue this isn't just some unique one-off event. It's actually part of recurring historical cycles, cycles of deglobalization or systemic breakdown that are often tied to empires losing their key sources of external subsidy or control.
Historical cycles of breakdown. Can you give us some examples from the source material? That sounds interesting.
Sure. The British Empire's experience is one key example they brought up. The source highlights how the British Empire essentially plundered India, described at the time as the world's richest place, using it as a massive subsidy, a flow of wealth and resources pouring back into Britain. When that control eventually waned and that subsidy was lost or diminished, it contributed significantly to the economic crises faced in Britain and the West in the 1920s and 30s.
So losing that external flow of value created systemic stress back in the imperial center.
Exactly. Another example cited was the Western financial empire in the 1970s. That system faced a major crisis when it effectively lost control over global energy resources, specifically oil, as producing countries like those in OPEC gained control and dramatically hiked prices.
The oil shocks.
Right. That shock contributed massively to the period of stagflation in the West. You had high inflation and slow economic growth happening at the same time. A nightmare scenario.
And the sources frame the current era we're in now as a third such chapter, another breakdown.
Yes, exactly. A third chapter in the breakdown of what's called the Western financial empire. Well, maybe it's not as openly brutal as the old colonial era. The disruption is presented as somewhat inevitable. The argument is any system that relies on a persistent subsidy, whether that's cheap labor from abroad, cheap resources, or other countries effectively funding your deficit by buying your debt, that system is inherently unstable when that subsidy or control mechanism starts to fail or break down.
Wow. So the analysis is pretty stark then. The current macro environment with its huge structural deficits, the wealth disparities, the geopolitical tensions, it's seen as an almost unavoidable outcome of this unsustainable system that's now actively unwinding.
Precisely. It's framed less as just a series of bad policy choices and more as the logical consequence of 40 plus years building a global system based on effectively exchanging paper currency for real goods. A system enabled by capital flows that have now shifted direction, creating instability both abroad and at home. It's presented as a fundamental structural unwinding, not just a temporary economic dip we can easily fix.
Okay, definitely something to think about. And if you want more deep dives like this, make sure you subscribe to the Snippet Labs YouTube channel. So this massive macro shift, this unwinding, it brings us directly to the role of Bitcoin, which the source material discusses with a really interesting and, maybe controversial perspective on its adoption by states and corporations.
This is exactly where we get into Alex Gladstein's thesis. It's framed in the sources as Bitcoin as the Trojan horse for freedom. And the core argument really goes against what a lot of people might initially think, maybe even some early Bitcoiners. The idea isn't that adoption by powerful institutions is bad for Bitcoin's mission. Instead, the sources argue this adoption is actually strengthening Bitcoin as a tool for individual freedom, not compromising it.
Trojan horse for freedom. Okay, that's deliberately provocative language. What's the core of this thesis as presented in the sources? How does that work?
Well, Gladstein's idea, which was elaborated on by the hosts, is essentially that Bitcoin was almost destined to become an obvious reserve asset for sovereign nations, for major corporations. It was just a matter of time. And the source asserts that this has now largely happened. They point to examples like MicroStrategy, Block, Tesla putting Bitcoin on their balance sheets, El Salvador adopting it as legal tender, and even increasing signs of U.S. states, maybe even the U.S. federal government, considering holding strategic Bitcoin reserves.
Okay, but surely there's a significant counterargument. A body of opinion, maybe especially among early Bitcoin supporters, that sees this institutional and government adoption as, negative, as a betrayal.
Oh, absolutely. The source explicitly acknowledges this contradictory take. It's a huge debate. Critics, including some original Bitcoiners, and they specifically cited figures like Ben Hunt, they view this embrace by Wall Street and governments as a fundamental betrayal of Bitcoin's original mission.
Which was what, in their view?
Which was to separate money from the state, to create a system outside of government control. So they see this adoption as co-option. The very powers Bitcoin was meant to circumvent are now getting involved, maybe trying to control it, or at least reduce it to just another speculative asset for the wealthy. Just about seeing your bags go up.
So the fear is the establishment is trying to take over or simply profit from it, neutering its revolutionary potential.
That's the essence of the critique.
Oh.
But the counterargument, put forward strongly by Gladstein and Pish in the sources, is that this adoption is fundamentally positive, despite appearances. They fully acknowledge that entities like BlackRock, or maybe a future Trump administration, or any government that starts mining Bitcoin, they are absolutely acting purely out of self-interest. They see a way to make money or gain strategic advantage or hedge against the old system.
Okay, fine. Their motivation is self-interest, but how does that translate into freedom for other people, especially people living under oppressive regimes, which is where that Trojan horse idea really seems aimed?
Right. That's the crucial mechanism the sources highlight. Bitcoin, they argue, has this unique machine inside of it, something inherent in its design. It takes the raw self-interest of these powerful actors, BlackRock wanting fees, a government wanting reserves, and almost paradoxically, it translates that into more freedom and utility for individuals globally.
How? What's the connection?
Because state and corporate adoption normalizes Bitcoin. It makes it boring, almost.
Normalizes it. How so?
Exactly. Think about it. If the U.S. government is doing Bitcoin stuff, maybe holding reserves, or if major Wall Street firms like BlackRock are offering Bitcoin ETFs, it significantly lowers the barrier to entry, and it reduces the suspicion around Bitcoin for everyone else. It makes it much harder for, say, a local bank or a repressive government to shut down the activities of individuals, nonprofits, journalists, activists, anyone who might need to use Bitcoin for legitimate purposes.
Like receiving donations from abroad or sending aid across borders without interference.
Precisely. If the biggest players are involved, it provides cover. It creates regulatory clarity, even if inadvertently. It makes it harder to paint Bitcoin users as fringe actors.
So it's like this big, giant network effect that ends up benefiting everyone on the network, even if some of the biggest participants are entities you might consider adversarial.
That's exactly the argument. The source contends that, unlike traditional fiat technology, which is centrally controlled by states and can be easily weaponized, blocking transactions, freezing accounts, inflating away savings, Bitcoin is fundamentally permissionless and decentralized. So even adoption by entities we don't like, Maybe governments with poor human rights records. Maybe large corporations focus solely on profit. Their participation actually works in Bitcoin's favor in the long run.
How?
Their participation adds liquidity to the market. It strengthens the network's security through mining incentives. It makes the whole ecosystem more robust and resilient. Ultimately, this makes Bitcoin a more effective and reliable tool for individuals who actually need it as an alternative.
It's presented almost as a life raft for the average person globally escaping the old system.
That's a core part of the argument, yeah. Bitcoin is framed as offering an escape route from those brutal cycles imposed by the traditional financial system. Cycles of currency devaluation, wiping out savings, persistent inflation eroding purchasing power, and restricted access to global financial networks. Things that affect billions of people worldwide, especially in developing nations.
And they gave examples.
Yeah, the source highlighted examples like activists using the Bitcoin Humanitarian Alliance to deliver aid directly, completely bypassing potentially corrupt or restrictive banking systems. That's powerful. It also democratizes investment access. I mean, Bitcoin has significantly outperformed the S&P 500 over the last, say, 15 years. But only a tiny fraction of the world's population can easily buy into the S&P 500.
Right.
The argument is basically everyone with an internet connection, even a cheap smartphone, can access Bitcoin, leveling the playing field in a way.
And they also noted that example of the former UK Prime Minister Liz Truss, right, attending a Bitcoin conference and publicly stating that Bitcoin takes power away from the governments. That seems significant.
Yeah, having a high-profile mainstream political figure say that openly definitely lends weight to the argument that Bitcoin is fundamentally shifting power dynamics. Even if governments are now trying to engage with it, they recognize this potential impact on their control. So yeah, while those competing narratives absolutely exist, adoption as betrayal versus adoption as freedom amplification, the sources we looked at strongly lean into the idea that Bitcoin's unique, permissionless nature means wider adoption, even by adversarial states or profit-driven corporations, ultimately strengthens it as a potent global freedom tool for individuals. It's a fascinating perspective.
A really powerful reframing of how we might think about institutional involvement. Okay, let's keep digging. If you're enjoying this analysis, follow us on Twitter @SnippetLabs for more updates and discussions. Now, moving from that broad macro picture, the philosophy of adoption, let's dive into some very specific corporate strategies that are leveraging Bitcoin right now, today.
Right. And this brings us squarely to MicroStrategy and the really detailed insights shared by guests like Andy Estrom and Jack Mallers on Preston Pish's show. The central concept here, the big idea, is Michael Saylor's creation of what they're calling the Bitcoin Torque playbook. It's described as a unique and, according to the sources, pretty much unprecedented corporate finance strategy, specifically designed for one purpose: to acquire Bitcoin. Relentlessly.
Bitcoin torque, or building a transmission, I think was another term used. How exactly does this mechanism work? How do they use corporate finance to just accumulate Bitcoin?
So as Andy Edstrom described it, the strategy involves using different capital buckets from within MicroStrategy's own corporate structure. This means strategically tapping into different parts of the capital markets. They do this by issuing common stock, sometimes preferred stock, and also convertible debt, different financial instruments.
Okay, so they raise money using these different methods, but what's the goal?
The purpose of raising all this capital, this fiat currency, is singular. It's explicitly to take that cash raised and immediately use it to buy Bitcoin, which is then held on the company's balance sheet as its primary treasury reserve asset.
So it's like MicroStrategy has effectively transformed itself into a kind of financial machine designed specifically to pull traditional money out of the market and convert it into Bitcoin holdings.
That's exactly the analogy used in the sources, like a pump or maybe a soda straw, sucking liquidity out of the global financial system.
Yeah.
The sources argue that, 4 decades of fiat money printing have led to global markets being potentially overcapped, meaning traditional assets like stocks and bonds might be significantly overvalued, priced as if nothing could ever fail. Extremely low risk premiums.
Right. Decades of low interest rates pushing asset prices up.
Exactly. And Saylor's strategy, according to this view, is brilliantly channeling this excess capital, this sort of potential energy, just sitting there in traditional markets, channeling it directly onto MicroStrategy's balance sheet, but converting it into Bitcoin along the way.
Okay, what are the key metrics or concepts we need to understand to grasp how this strategy actually works and why it's potentially so effective?
One absolutely crucial metric discussed is MNAV. That stands for market cap, divided by the net asset value of the company's Bitcoin holdings. So how much the market values the company versus the actual Bitcoin it holds. The core insight here, the key to the torque, is that if MicroStrategy's stock is trading at an MNAV greater than 1, meaning the market values the company at more than just the spot value of its Bitcoin, then issuing new stock to raise capital becomes incredibly beneficial for accumulating more Bitcoin accretively.
Why? Why is issuing stock when MNAV is greater than 1 so advantageous for them?
Because you're essentially selling shares in your company for more than the pro rata value of the Bitcoin already on your balance sheet represents. The source described it as being like getting Bitcoin at half off, or potentially even better depending on the premium.
How does that work?
Well, if your MNAV is, say, 2, that means the market values each dollar of Bitcoin you hold at $2 of market cap. So if you issue new stock, you create, say, a dollar of market capitalization. You take that dollar raised and buy $1 worth of Bitcoin. But the market was already valuing your existing Bitcoin at that 2x premium. So effectively, you're acquiring new Bitcoin below the market's implied valuation for your existing holdings. It juices the amount of Bitcoin per share.
Ah, okay. I see the leverage there.
Yeah, and a specific 3.9x ratio was mentioned in the sources as an example of this leverage at certain points, indicating that at certain high valuations, issuing common stock could allow them to add Bitcoin worth almost 4 times the value of the stock issued relative to their existing capital structure. Powerful financial engineering.
And they don't just use common stock, right? They use preferred stock, too.
Right. They strategically use different types of capital, like preferred stock. This allows them to tap into different pools of investors, people who might have specific mandates, like needing income or yield, or maybe perceiving preferreds as lower risk compared to common stock. And the source discussed how MicroStrategy's very large Bitcoin treasury actually provides a kind of solid backing for these preferred shareholders. It gives the balance sheet health, ensuring those dividend payments can likely be made.
They mentioned a specific yield.
Yeah, they mentioned a 10% cash dividend yield on some preferred issuances, which is pretty high in today's environment. And this was framed as potentially helping to normalize higher yields in traditional finance again, which has seen returns suppressed for so long due to central bank policies.
Okay, but there's this common perception, you hear it all the time, that MicroStrategy is incredibly risky precisely because they've taken on significant debt to buy Bitcoin. How do the sources address that specific concern?
Yeah, they push back on that narrative pretty strongly. The sources asserts that if you actually look at MicroStrategy's debt-to-equity ratio, a standard balance sheet metric, it's actually better today than it was back in 2020, before they started the whole Bitcoin strategy.
Really? How is that possible if they issued debt?
Because the argument is that the massive appreciation in the value of their Bitcoin treasury holdings has far outpaced the increase in the nominal amount of debt they've taken on. So the equity side of the ratio has grown much faster than the debt side, actually making the company's balance sheet look stronger by that traditional metric. It's counterintuitive, maybe.
So the overall analysis presented is that this Bitcoin torque strategy is genuinely unprecedented in corporate finance. It's something new.
That's how it's framed, yeah. And it's what has enabled MicroStrategy, a company which, let's be honest, has relatively modest operational revenue growth from its core software business to massively outperform even high-flying assets like NVIDIA over the past 5 years. And they did it purely through this specific method of accumulating Bitcoin by cleverly leveraging different parts of its capital structure.
So the incredible stock performance isn't really coming from explosive software sales growth. It's coming from the company becoming this highly efficient, publicly traded vehicle for Bitcoin accumulation.
That's exactly the argument. Michael Saylor is seen as almost forcing Wall Street to confront this reality, pushing their eyes open, as one source put it, simply by pointing to the performance numbers. The sources quoted him essentially saying, paraphrasing here, look, I outperformed NVIDIA by a huge margin over the last 5 years, and all my company did, which makes maybe $75 million a year in actual operational profit, was buy Bitcoin using these capital market strategies. It's a stark comparison.
The implications for traditional finance could be really huge if this playbook starts getting replicated by others.
The sources definitely suggest it could be potentially an atomic bomb for long-duration fixed income markets. That's a direct quote. Think about it. If financially healthy companies can start offering preferred stock with, say, 10% yields, and those yields are plausibly backed by appreciating assets like Bitcoin, it fundamentally changes the entire landscape for investors who've been stuck with near-zero yields in traditional bonds for years and years.
Where do public Bitcoin mining companies fit into this picture then? They're also publicly traded, obviously tied to Bitcoin. Are they doing the same thing?
The sources draw a pretty clear distinction there. MicroStrategy is seen as a pure play on Bitcoin accumulation, specifically using capital markets.
Hmm.
Public miners, however, describe more as bundled businesses. They have exposure to Bitcoin, yes, but they also face significant operational challenges and complexities that MicroStrategy doesn't.
Like what kind of challenges?
Well, dependency on a single dominant ASIC chip supplier, Bitmain primarily, intense global competition from other miners all around the world, and importantly, competition from potentially strategic or even uneconomic players. Think about governments or state-subsidized entities who might mine Bitcoin not just for immediate profit, but maybe to ensure they have a physical footprint in the network for geopolitical reasons, or to secure their own transactions if they feel they can't rely on the traditional dollar system anymore.
Ah, okay. So miners have all this operational complexity, competitive pressure.
Exactly. And according to the sources, this makes them inherently less of a pure play on the underlying asset, Bitcoin itself, compared to MicroStrategy's cleaner capital markets approach. And this difference might explain why MicroStrategy's stock has, at least recently, generally outperformed many of the mining stocks. The market seems to prefer that cleaner exposure.
So the market prefers the simpler, pure play on Bitcoin accumulation via the capital market strategy.
That appears to be the analysis presented in the sources, yes. And looking ahead, they anticipate that other companies will likely start trying to copy this Bitcoin Torque playbook. As the market appetite for this kind of direct, leveraged Bitcoin exposure grows.
Which would mean competition for MicroStrategy in accessing that capital.
Yes, it will introduce competition for MicroStrategy in tapping those capital buckets. But it also, in a way, validates the overall strategy and potentially grows the whole pie.
Really fascinating stuff. Don't forget to subscribe to the Snippet Labs YouTube channel if you want to catch all our deep dives. Okay, that was an incredibly detailed look at MicroStrategy's unique corporate blueprint for leveraging Bitcoin. Now, let's shift focus again. Let's look at companies that are trying to build entirely new financial services and infrastructure on top of the Bitcoin network itself. This brings us to Jack Mallers' ventures, specifically 21 and Strike.
Right. This is really about building out a more Bitcoin-native financial system, or at least constructing the crucial bridges between the traditional world and the Bitcoin ecosystem. Let's start with 21, which is often referred to by its proposed ticker symbol, XXY.
Okay, what is 21's core aim? What are they trying to build?
So, the sources explain that 21 aims to become a publicly traded entity available on stock exchanges, but one that offers capital markets a fundamentally new kind of exposure to Bitcoin. Specifically, the goal is accretive exposure. And this is a key distinction the sources emphasize. It differentiates 21 from more static investment vehicles, like a simple spot Bitcoin ETF, which just passively holds Bitcoin.
Okay, so it's not just a company whose stock price goes up and down based purely on the value of the Bitcoin it happens to hold. There's more to it.
Correct. As described in the sources, 21 is proposed to go public via a SPAC deal merging with Cantor Equity Partners. And it's structured explicitly as an operating company with a clearly defined goal for its leadership team to actively grow the amount of Bitcoin the company holds per share over time, not just maintain it passively.
That's a really crucial difference, isn't it? It implies that management performance is a key factor, not just the underlying price of Bitcoin itself.
Absolutely. It's an active strategy. And so what are the key performance indicators, the KPIs, for 21 then? How do they measure success?
They highlight two main ones in the sources. First is Bitcoin per share, or BPS.
This is the direct measure of that accretive exposure they're aiming for. How much actual Bitcoin does each share of XXI stock represent? And the management's stated goal is to consistently increase this number through their operations and through smart capital raising activities.
Okay, BPS. And the second KPI.
The second is the Bitcoin return rate, or BRR, which is basically analogous to a traditional return on investment, ROI. It measures the rate at which they are successfully growing that BPS figure over time. How efficiently are they compounding the Bitcoin per share?
What's the operational plan that was outlined for 21 in the sources? How do they plan to achieve this?
Well, based on the public filing information that was discussed in the sources, the plan seems to have distinct phases. Phase 1 is primarily accumulation, really focused on growing that Bitcoin per share figure, building the base. Phase 2 is centered around education and branding, building awareness, and helping the market understand their unique accretive model, differentiating it from ETFs. And then phase 3 is termed BTC-focused finance. This is where they apparently plan to build out and offer actual Bitcoin native financial services on top of their accumulated base.
Have they had any success in raising capital for this vision already before the public listing?
Yes, the sources mention they've successfully raised capital already, including through things like a convertible bond instrument, and that this attracted interest from some large pools of capital. SoftBank, for instance, was mentioned as an early investor, and the sources characterize SoftBank's interest as seeing 21 as a potentially unique vehicle, a way to take their investment dollars the furthest when it goes to Bitcoin exposure, presumably because of that accretive compounding potential baked into the model compared to just buying spot Bitcoin.
So the analysis here is that 21 is aiming to provide a more dynamic way for traditional capital markets to participate in the Bitcoin story, more active than simply buying spot Bitcoin or a passive ETF.
Exactly. It offers exposure to the underlying asset, Bitcoin, but it also explicitly relies on the performance of the management team to actually grow that underlying asset base per share through strategic operations and capital allocation.
It's framed as a potentially new type of public company, really, designed specifically to compound its Bitcoin value, bridging traditional finance with the Bitcoin ecosystem in a very active, performance-driven way.
Yeah, it's a novel approach.
Okay, now let's move over to Strike, Jack Mallers' other well-known company. And their significant focus, as discussed in the sources, on democratizing collateralized lending using Bitcoin. This feels like building a really core piece of a potential future financial system.
It absolutely does. And the sources, importantly, immediately address the elephant in the room, right? The well-documented, frankly disastrous failures of previous crypto lending platforms, BlockFi, Celsius, all the issues surrounding SBF's ventures. Strike's explicit aim, as discussed loud and clear, is to do this the right way, transparently, responsibly, and importantly, doing it at significant scale.
What kind of scale are we talking about? Did they give numbers?
Yeah, the source notes they are already operating at pretty immense scale, having processed something like over $6 billion in volume just in 2024 alone. And they're apparently serving rapidly growing customer cohorts who have a fundamental need for these kinds of loan products, using their Bitcoin as collateral.
Now, a crucial distinction was made in the sources, wasn't it? Essential to understanding Strike's loan product, the difference between types of debt.
Yes, absolutely critical distinction. They differentiate very clearly between bad debt and good debt.
Okay, how do they define bad debt?
Bad debt is described primarily as uncollateralized debt. Things like student loans, high-interest credit card debt, payday loans. Stuff not backed by a specific asset. The source characterizes these pretty strongly as forms of debt slavery, because they're often high interest, unsecured, maybe used for depreciating assets or just consumption, and they can easily trap individuals in these relentless cycles of repayment.
Okay, so that's bad debt. What's good debt then?
Good debt, in contrast, is defined as collateralized debt, specifically borrowing against an appreciating asset, or at least an asset you expect to appreciate.
So Strike is firmly aiming to offer good debt.
Yes, that's the goal. By offering Bitcoin collateralized loans, they are aiming to make the kind of strategy that's traditionally only been used by the wealthy. Borrowing against your stock portfolio or your real estate holdings without actually selling them, making that strategy available to potentially everyone who holds Bitcoin.
And the idea is to allow the money printer, so to speak, the effects of monetary expansion to work for you instead of against you.
That's the framing, yeah. Enabling access to liquidity, cash when you need it, without triggering a taxable event by selling your Bitcoin. And doing it at potentially favorable interest rates, precisely because the loan is secured by that Bitcoin collateral.
What kind of terms are they actually offering on these Bitcoin collateralized loans, according to the sources?
The sources mention them aiming for single-digit APRs, annual percentage rates, specifically citing examples in the range of, say, 8% to 9%. And they describe this as potentially the best in the world by a long margin for this specific type of lending product, especially when you compare it to other borrowing options available to average individuals globally, like credit cards or unsecured personal loans.
How can they offer such relatively low rates, especially when the potential lenders on their platform could arguably get higher returns, historically at least, just by holding the Bitcoin themselves? What's the incentive for lenders?
That's a great question. The source explains that Strike is actively working to orange pill large pools of capital, which is Bitcoin community slang for educating and convincing institutional investors, high net worth individuals, maybe even other companies, to become lenders on their platform, to supply the capital for these loans. By bringing in significant volume of this lending capital, they can help drive down the interest rates offered to the borrowers, creating a competitive market. even factoring in the opportunity cost for those lenders who could otherwise just hold their Bitcoin and hope it appreciates faster than the loan interest.
Okay, so they're building both sides of the market. What's the typical structure of these loans as described in the sources?
The main example structure detailed is a 50% loan-to-value, or LTV,
Rena.
meaning for every, say, $100 worth of Bitcoin you put up as collateral, you can borrow $50 in cash. It's also described generally as a payment at maturity product, often with annual interest accrual.
Okay, what does payment at maturity mean in practice?
It means you typically don't make monthly interest payments like you would on a mortgage or a car loan. Instead, the interest accrues over the term of the loan, maybe a year, and it gets rolled into the principal amount owed. Then the full amount, the original principal you borrowed, plus all the accrued interest, is due in one lump sum at the end of the loan term.
Okay, let's try and walk through that hypothetical example provided in the sources, just to really understand how this could potentially work for an individual user.
Sounds good. Okay, let's imagine someone, maybe they earn a $100,000 annual salary, and maybe their savings are primarily held in Bitcoin. Let's say, for simplicity, Bitcoin's price is $100,000 per coin at the start of this example. And this person needs $100,000 in cash for some purpose. Maybe it's a down payment on a house, maybe seed money for a business, maybe just living expenses for the year. So using Strike, they decide to put up $200,000 worth of their Bitcoin, so 2 BTC in this example, as collateral.
Okay, $200 K collateral at a 50% LTV.
They can borrow $100,000 in cash.
Right.
And let's assume, for this example, the loan APR is 10%.
Okay, so they get the $100 K cash. What happens over the next year in this hypothetical scenario?
Well, the individual continues to earn their $100,000 salary. And maybe they choose to continue stacking that salary into Bitcoin throughout the year, dollar cost averaging. Crucially, their original $200,000 worth of Bitcoin collateral just sits there, untouched. And it continues to appreciate if the price of Bitcoin rises during that year. Let's follow the example's assumption from the source, which used a hypothetical, maybe optimistic, 50% annual compound rate for Bitcoin over that year.
Okay, 50% appreciation.
So their original $200,000 collateral is now worth $300,000. That's 200K 1.5. And if they also stack their $100,000 salary into Bitcoin throughout the year, that $100,000 worth of fiat would also have been converted into Bitcoin and potentially appreciated as well. Following the example's kind of end result calculation provided in the source, let's assume their total Bitcoin value at the end of the year, including the appreciated collateral and the appreciated stack salary, is now, say, $450,000.
Okay, so their Bitcoin net worth has grown significantly on paper. Now, at the end of that year, what do they owe on the original loan?
They owe the original $100,000 principal they borrowed, plus 1 year of 10% interest, which is $10,000. So the total amount due is $110,000.
Right. How did they pay that $110,000 back without selling their original $200,000 Bitcoin stack, which was the whole point?
This is where the rollover feature, as described, comes into play. It's key. With their total Bitcoin value now sitting at $450,000, they can potentially take out a new loan, again at the same 50% LTV.
Okay, a new 50% LTV loan on $450,000 worth of Bitcoin would be $225,000.
Exactly. They can borrow up to $225,000 again at their current Bitcoin holdings.
Yeah.
So they take out that new loan. They immediately use a portion of that new $225,000 loan, specifically $110,000 of it, to pay off the old loan in full, the original $100K principal plus the $10 interest.
Okay, old loan paid off. How much of that new $225,000 loan is left over?
They have $115,000 remaining. $225,000 from the new loan minus the $110,000 used to pay off the old one. And according to the sources, they can then potentially use that $115,000 cash for their living expenses for the next year, or paying bills, reinvesting, whatever they need, all while their original Bitcoin stack, the Bitcoin they stacked from their salary, remains intact, continuing to hopefully grow or compound over time. The source even mentioned the potential for this to be seamlessly integrated into things like bill payment systems, maybe even offered instantly via the app.
That mathematical example definitely highlights the potential leverage. I mean, accessing cash flow without selling your appreciating asset. But wow, it sounds like it relies very heavily on Bitcoin continuing to appreciate significantly year after year. That 50% assumption is doing a lot of work there.
You've absolutely hit on the crucial point and the primary risk, which, to be fair, the sources explicitly address. They were very clear about this. This strategy is not presented as some kind of silver bullet or a guaranteed risk-free way to get rich. It carries significant risk. And yes, the positive outcome described in that specific example relies heavily on Bitcoin appreciating substantially, using that 50% annual compound rate assumption.
So what is the main risk highlighted? What's the downside scenario?
The biggest risk is over-leveraging yourself based on optimistic past performance assumptions and then getting completely wrecked, as they say. Facing potential liquidation of your collateral if the market turns against you.
Meaning if the price of Bitcoin drops substantially instead of rising.
Exactly. If the price of Bitcoin falls significantly, the value of your collateral falls with it. If it drops below a certain threshold, related to your LTV and margin requirements, the lender needs to protect their loan. They might issue a margin call, requiring you to add more collateral or pay down the loan. Or if you can't meet that call, they may be forced to liquidate, to sell your Bitcoin collateral on the open market to recover the amount you owe them. You lose your Bitcoin.
And that risk is particularly dangerous if someone gets comfortable and increases their lifestyle spending based on those paper gains they see in the positive scenario.
Absolutely. That's a classic trap. As the source explicitly states, debt is like fire. It can be incredibly useful, a powerful tool for building wealth when used responsibly. But it is also inherently dangerous, especially when collateralized by a volatile asset like Bitcoin. It must be managed with extreme caution and respect for the potential downside.
Makes sense. Now, given the history of failures in this crypto lending space, building trust and ensuring transparency must be absolutely paramount for Strike.
Huge focus, yes. How are they addressing that, according to the sources?
A key point emphasized is no rehypothecation.
Meaning
that your Bitcoin collateral, once you deposit it to back your loan, is not being simultaneously lent out somewhere else by Strike to earn extra yield. It's supposed to be held one-to-one, specifically backing your loan, not pooled and reused, which was a major issue with some failed platforms.
Okay, no rehypothecation. What else?
They also apparently have proof of reserves on their product roadmap. This would theoretically allow users to cryptographically verify on the blockchain that the company actually holds the Bitcoin they claim to hold as collateral backing all the outstanding loans, providing verifiable transparency.
They're also exploring different trust models, things like regular quarterly or maybe even monthly audits by third parties to provide ongoing assurance to users and lenders. Building that trust layer is critical.
And this loan product, this whole vision, it's intended for broad global access.
Yes. The sources mentioned Strike already serves customers in over 100 countries, and the vision articulated is absolutely to make this type of potentially low APR Bitcoin collateralized loan product globally accessible, potentially overcoming traditional barriers individuals face in accessing affordable credit in many parts of the world. And again, that ambition of potentially offering it near instantly via the app. Download my app, will give you a loan in 60 seconds, secured by an asset that could potentially compound significantly over time.
So the overall analysis here is that Strike is attempting to build trust and achieve significant scale in a sector that's been previously scarred by mismanagement and failure. They're offering what could be a powerful financial tool for individuals worldwide to leverage their Bitcoin holdings without selling, but it comes with that huge flashing neon caveat. Users absolutely must understand and responsibly manage the inherent price volatility risk of the underlying Bitcoin collateral.
Exactly. It's about democratizing a financial strategy, previously reserved mainly for the wealthy, using Bitcoin as the foundational collateral, but emphasizing constantly that leverage cuts both ways. It magnifies gains, but it also magnifies losses. Risk management is everything.
Absolutely crucial point. Okay, one more reminder. Drop a like and share if you find this valuable. And definitely follow us on Twitter at Snippet Labs for more updates. And please subscribe to the Snippet Labs YouTube channel. We've covered some really immense territory today, haven't we? Exploring these very different, yet somehow connected business blueprints.
We really have. Yeah, we started right down in the trenches, the nitty-gritty tactical hustle of e-commerce, realizing that success, even with seemingly simple products like a wallet, demands absolute mastery of customer acquisition economics, especially in those low LTV environments where you only get one shot, and how increasingly rapid growth seems to be found by spotting those fast trends early and really leaning into newer, sometimes chaotic marketing channels like that TikTok blueprint, high-volume organic content.
Then yeah, we zoomed way out to the macro level, viewing the current global financial system not as stable, but as this massive, potentially unsustainable structure that's actively unwinding right now. And how this unwinding, presented as almost an inevitable outcome of long-term historical cycles, tied to losing external subsidies or control, how it creates this incredibly volatile backdrop for all businesses, all finance today.
And within that huge macro context, we explored Bitcoin's a complex, often controversial role, argued not just as another speculative asset, but potentially as this Trojan horse for freedom, where paradoxically, even adoption by powerful states and giant corporations, often driven purely by self-interest, might actually strengthen its utility and resilience as a permissionless global tool for individuals.
Yeah, that was a fascinating perspective. And we saw how a company like MicroStrategy is building this completely unprecedented corporate finance playbook, effectively acting as a pump, extracting liquidity from traditional markets and channeling it directly into Bitcoin, becoming this highly efficient, publicly traded, pure play vehicle for Bitcoin accumulation that has, frankly, significantly outperformed most other assets recently.
And then finally, yeah, we looked at companies like 21 trying to build these new public equity structures designed for dynamic, accretive Bitcoin participation, growing Bitcoin per share. And Strike, building these potentially large-scale, hopefully trustworthy Bitcoin collateralized lending platforms, both aiming in different ways to democratize access to powerful financial strategies like borrowing against your assets without selling them, strategies previously confined mainly to the wealthy, using Bitcoin as the core collateral base, but always stressing that critical importance of risk management.
It's really fascinating when you lay it all out like that to see how these completely different business blueprints, I mean, from selling wallets online to navigating global currency shifts to building entirely new financial systems on Bitcoin, they all seem to rely on some fundamental, maybe enduring principles, don't they?
I think they absolutely do. Principles like finding and applying leverage, whether that's leveraging your marketing channels, leveraging your corporate capital structure, or direct financial leverage on an asset like Bitcoin. Finding that edge, it always requires a really deep understanding of market dynamics. Where is value actually being created? Where is it being destroyed? Where are the real opportunities emerging from these big structural shifts?
Yeah.
It's about capitalizing on those opportunities with decisive action, whether that's catching a fast e-commerce trend just right or implementing a totally novel corporate finance strategy like Sailors. You have to act. And underpinning almost all of it, especially as things scale, is the absolute necessity of building trust. Whether that's trust in your consumer brand or trust in a financial platform that's holding potentially someone's life savings as collateral.
Yeah. The specific tools change dramatically, don't they? From Facebook ads yesterday to maybe TikTok algorithms today to Bitcoin tomorrow. From global trade deficits to collateralized debt structures. But those core principles, leverage, understanding market dynamics, seizing opportunity, and building trust, they seem kind of timeless, applicable across all these different scales and contexts.
I think so. The fundamentals remain, even as the landscape shifts.
So the big question for you, listening, what does all this mean for you? How can you take these insights, these different blueprints, and maybe apply them to your own situation? Whether you're thinking about starting or growing a business, or maybe just managing your personal finances, or even simply trying to make sense of a world that feels like it's undergoing pretty significant change. How do these different blueprints for finding opportunity, for building value, for protecting yourself financially, how do they resonate with your own journey? Something to consider. Consider the sparks.
Ideas ignite empires. Pay attention to the sparks.